If you're watching this, you probably already feel that there's something wrong with the Canadian dollar, and your intuition is not wrong. So let's take a few moments and lean into your gut feeling, identify the precise nature of it, and discover why this is true. After I present some empirical evidence, I think that when you review this, you'll find that you're not all that wrong. Most people are completely ignorant to the reality of the economy and the reality of the strength and the devaluation of the dollar over time. They think about why 40, 50 years ago, a family could live on a single income and live well. And now it takes 2 and even 3 incomes in a single household just to get by. All those myths are going to be dispelled in this video. So let's start out with reality number 1, that the Canadian dollar would be equivalent to the worst stock you ever bought. If you bought the Canadian dollar as a stock in 1995 and held on to it long term, you're down somewhere between 45 and 50% overall, depending on the benchmark that you're using, whether that's CPI, food inflation, housing, or other inflationary measures. And if you zoom out even further and take a broader picture of this, the Canadian dollar has lost about 90% of its purchasing power since 1935. A 1935 Canadian dollar now buys about 5 to 7 cents worth of goods today. This is not a recession. This is not a system that's breaking. This is the proper outcome of an improper policy or improper system. So the question we have to ask ourselves is this: is the destruction of the Canadian dollar an accident or a predictable consequence of how the system was designed? It is now factually correct to consider the value of silver and exchange for a Canadian dollar at about $110 today. And many people in the silver industry or the silver market would argue that the value of a Canadian dollar is worth 1/110th of an ounce of silver, not that a value of an ounce of silver is worth $110. The core premise here is that inflation is not neutral. Milton Friedman was an economist most aligned with the Chicago school, and his comments on inflation are not necessarily just about Chicago. They're not also just about America, but generally applied across the world. Inflation is always and everywhere a monetary phenomenon. If the supply of dollars grows faster than the supply of goods and services, then the exchange value of those dollars must lose value. Now, the economists aligned with the Austrian school take it another step further, and they ask these questions. Who creates the new money? Who gets it first? And how does this distort the structure of the economy overall? Now, Austrian economist great F.A. Hayek warned us with this statement. History is largely a history of inflation, usually inflation engineered by governments. Now, in the Canadian framework, this isn't some mere conspiracy theory. This is actually how the structure of monetary policy works. Now let's go through a bit of history so that you'll see the patterns emerge. In 1935, the Bank of Canada was created. Now before the Bank of Canada was created, Canada operated on a gold monetary basis and a decentralized banking system. Chartered banks issued their own banknotes on their own, and while the system was far from perfect, it had a defining feature that all modern Canadians have never experienced. And that is, the supply of money was constrained by the supply of gold. A Canadian dollar wasn't simply a promise, not backed by anything. It was actually a receipt or a claim on a specified weight of gold. Now, this meant that politicians were restricted from arbitrarily raising the money supply. Banks had to maintain actual reserves against the dollars that they issued, and prices over the long term were remarkably stable. From an Austrian economics perspective, this meant that the money had something tangible to weigh it down, an era where money had a hard anchor, and it meant stability when it could be redeemed for something tangible. The purchasing power of each dollar did not melt away year after year. Now, this all changed in 1933 when U.S. President Franklin Roosevelt took America off gold domestically and confiscated private-owned gold and repriced it from just over $21 an ounce to $35 an ounce. And that single act had a global effect. Number one, it instantly devalued the US dollar by 41% overnight. It created a huge arbitrage opportunity for gold producing and gold hoarding nations. And around the world, gold prices rose as they were repricing into the new US rate. Of course, Canada is a major gold producer and heavily tied to the economy of the United States. Between 1933 and 1935, Canada reacted quickly and liquidated most of its gold supply and sold it to the US government. And the reasons were strategic and political. The first one being, of course, arbitrage, selling high and locking in those gains. After the US devaluation, Canada could sell its gold on the international market at the new price of $35 an ounce and convert those proceeds into fiscal spending. The second reason was to stabilize the exchange rate between the US and Canadian dollar. The Canadian economy has always been deeply integrated with that of America, and the overnight devaluation of the US dollar forced Canada to make a choice: devalue with the US or lose competitiveness overnight. Selling the gold on reserve allowed Canada to monitor and with some flexibility its exchange rate with the US dollar. The third reason were fiscal pressures resulting from the Great Depression. The 1930s in Canada were brutal. High unemployment, falling government revenues, and collapsing commodity prices. Selling gold was a great way to raise liquidity without raising taxes to fund some of the benefits programs that were in place at the time. The number four reason was the political trend away from hard money. Once the economy of the United States, which is the largest in the world, effectively abandoned the classical gold standard, it sent a signal to the globe. The age of politically constrained money was ending, and the age of politically managed money was beginning. And Canada followed this shift. And by 1935, as Canada founded the Bank of Canada, most of the nation's reserves were significantly depleted. This timing was not accidental. It essentially meant the new Bank of Canada, this new system of monetary policy, would inherit a system unconstrained by the weight and tie of the gold standard. Monetary policy would be governed and controlled by discretion, not by a hard anchor. Inflation, which was now gradual, persistent, and institutionalized, was baked into the structure of the system. And this was the exact transition that the Austrian economists tried to warn us about. Mises wrote, "The gold standard alone makes the determination of the purchasing power of money independent of the ambitions and machinations of governments." And Hayek echoed, "Once government has the power to debase the currency, in the long run, it will do so." With the creation of the Bank of Canada, the country moved from a decentralized gold-backed standard money system to a central issuer with full power of issuing notes and control over reserves. For the first time in history, the supply of the Canadian dollar moved independently of the gold reserves, and it did. Prices, which had been historically flat over the long run, now started to rise in the long term. And in 1970, Canada finalized its ties with gold convertibility. This marked the beginning of full fiat money, where the value of the dollar relied exclusively on the discipline and policies of the Bank of Canada. With no hard constraint on the issuance of money, inflation surged, and in the early 1980s it peaked at 12%. Real wages were squeezed while housing prices and commodity prices soared, and the purchasing power of the Canadian dollar declined dramatically. Now in 1991, the Bank of Canada introduced its now famous 2% inflation target. And this policy has been renewed several times in contracts with the federal government. This policy, by the way, is set to renew again in 2026. This meant that the perpetual loss of the purchasing power of the dollar was no longer an accident. It was a policy. And at 2% inflation rate, the dollar loses approximately half its purchasing power every 35 years. In other words, the central bank was in charge of a slow, continuous dilution of the value of money. So while the bank has a broad statutory mandate under the Bank of Canada Act to, quote, regulate credit and money, mitigate fluctuations in prices, and generally promote the economic welfare of Canada, the specific quantitative target of 2% is not specifically named in the Act. Rather, it's set by a negotiated agreement between the central bank and the federal government. And this has moral hazard written all over it. If the target is negotiable, then monetary expansion or deviation becomes easier to justify in times of exceptional circumstances, which does nothing but erode the long-term trust in the currency. From an Austrian lens, which emphasizes sound money, fixed rules, and protection of money holders from politicians' discretion, this is a structural vulnerability. The inflation target regime institutionalizes managed decay, even though it may be moderate or even predictable, rather than a genuine commitment to stable money value. Although less publicized than the United States, Canada embraced a large-scale quantitative easing program in the 2008 financial crisis and repeated itself dramatically in 2020. Hundreds of billions of dollars were injected into the financial system. Government deficits were financed indirectly, and the supply of money surged. The Bank of Canada, for all intents and purposes, printed billions of dollars. Federal deficits hit peacetime records. M2 money supply surged. Housing prices disconnected from reality, and CPI hit 40-year highs. Put plainly, the Canadian dollar's purchasing power declined more substantially than in any other time in modern history. And at the danger of repeating myself, Austrian economists have been saying this for the last 100 and plus years. Hayek referred to the fact that government, once it owns the power to debase the currency, it will continue to do so, and Canada followed that script verbatim. Ludwig von Mises wrote extensively about this dynamic, and he said this: credit expansion can never be used as a permanent policy. The boom must always collapse. Now I want to move into a bit of psychology and talk about a priori logic. Because you have more Canadian dollars in the system, that just equals weaker Canadian dollars in the system. And this is a priori because it doesn't need statistics to prove it, just basic reasoning. Imagine the Canadian economy as a fixed value of goods and services, a economic pie, if you will. And if the Bank of Canada creates billions more dollars over that same value of goods and services, you do not create more wealth, you create more claims against that wealth. It's not a bigger pie, it's more people fighting over the same slices. And this is why inflation is both an economic and moral issue. Because who gets the dollars first? Not you, not consumers, not small businesses. The first receivers are always the banks, the bondholders, the government contractors, and large institutions. By the time this new money starts hitting the streets and the workers and the savers, prices on commodities have already started to shift. Austrians call this the Cantillon effect, and Canada is one of the closest and real-world examples of it. So let's look at some empirical data now, just to prove the theory. Since 1935, the Canadian dollar has lost somewhere between 93 and 95% of its purchasing power. Since 1970, the dollar has lost about 80% of its value against housing and essentials. Even at a 2% inflation target rate, the Bank of Canada is set on a moral and economic decay of the dollar. In other words, the Canadian dollar is falling predictably towards zero. This destruction is not random or chaos. It's exactly how the system was designed. Now, why should this matter to Canadians specifically? Well, all this money expansion means a few things. Number one, Canada's cost of living is more sensitive to monetary expansion. Housing, which responds fastest to cheap credit, dominates the Canadian family budget. Number two, Canadians hold more of their savings than any other country in the banking system, meaning the tax of inflation bites harder. Number three, Canada has one of the highest debt loads in the G7. Debt plus inflation is essentially a government incentive to quietly default through currency debasement. And to quote Hayek again, with government in control of the money, the chief safeguard of liberty is gone. So here's the argument in one sentence. In a system where the Bank of Canada can create unlimited money to finance deficits and manage political crises, the long-term erosion of the Canadian dollar is not by accident. It's the rational, predictable outcomes of the system's incentives. It is a priority because increasing the money supply faster than the economy is growing must devalue the dollar. It's empirical because Canada's century-long inflation issue confirms exactly this pattern. And it is easy to understand because anyone can see this simple truth. The dollar today buys less than it ever has, and it always will, because the people who issue it benefit when it buys less. So this isn't fear-mongering or pearl-clutching. The dollar is neither stable nor neutral, and it is not designed to protect your wealth. Inflation is not an accident of economics. It's a deliberate feature of the Canadian monetary system. You cannot store time, labor, or wealth in a currency that's programmed to decay. The Canadian modern monetary system was deliberately designed to create inflation with an explicit but mutable target. That mutability, combined with discretionary central bank power, is a feature of this system. Now, what you can do is learn how money works, learn how inflation operates, and learn how to protect your wealth from a system that is quietly taxing it every year. If you found this video to be helpful and you want some more clear, no BS explanations about money, finance, history, economics, financial literacy, politics, and psychology philosophy, make sure you hit like, subscribe, and hit that notification bell for more upcoming videos. Because in a world of melting money, misunderstanding or pleading ignorance is no longer optional.